Happy New Year and welcome to the FMLS Market Intel Report. I'm Leslie Appleton-Young, Chief Economist for FMLS. As we begin the new year, we find ourselves in a bit of a holding pattern, and it's way too early to assess the accuracy of the 2025 market forecasts. I can, however, confirm with 100% accuracy that projecting mortgage rates remains a high-risk activity. Last September, a faltering labor market and slowing price gains led the Fed to initiate a series of rate cuts. The 50 basis point cut on September 18th pushed mortgage rates down to 6% by month end, and there was every expectation that further cuts were coming. Well, not so fast. Today, mortgage rates are hovering around 7%, and the Fed is not expected to cut again until mid-year, if at all. What happened and what does this mean for the housing market? On the inflation front, price declines have stalled, and the uncertain impact of new tariffs are concerning the Fed and investors. There's also worry over the scale of government borrowing, debt sustainability, and even the impact the recent fires that devastated Los Angeles could have on growth and inflation. As for the labor market, an unexpectedly strong gain of 256,000 new jobs in December generated fear among investors that the robust economy, along with the possibility of higher inflation, would sideline the Fed's plan to lower rates. Stocks took a significant tumble. As we have seen before, investors' expectations about where the economy is headed in the future are a powerful force in determining rates. We will know more at the end of January when the economic policies of the incoming administration are more concrete. So where are we? The 2025 forecast narrative says that inflation will be controlled, the economy will grow, but more slowly, the Fed will cut at a cautious pace, and rates will gradually decline throughout the year. The housing market will see more inventory, moderately higher prices, and slightly more sales. Does this change if 6.5% or even 7% is the new normal for mortgage rates? Market data for the week of January 5th offers a glimpse at what might be brewing. It's a significant week because it's the first in the last three not directly impacted by holidays. With Christmas and New Year's falling on Wednesdays, housing market activity was sidelined by travel and time off, and this is reflected in the data. New listings dropped on a year-over-year basis by 10% the week ending December 28th and by 15% the following week, but they were up 6.75% for the week ending January 11th, kind of back to normal. Closings were down 15% for the week ending December 22nd, up 4% the following week, and up a full 61% for the week ending January 11th. What we see is a glimmer of the expected forecast with more inventory and more sales, both still well below pre-pandemic levels, but encouraging nonetheless. Going forward, a lot hinges on the extent to which consumer expectations about mortgage rates have re-anchored themselves to a higher mortgage rate environment. What are the key takeaways for market participants? For buyers, don't wait for rates to hit 5.5% or even 6% in 2025. That's very unlikely to happen, at least at this point. Do the math. Weigh mortgage rates against the price appreciation in your market. It may not make sense to wait. And for sellers, price your property competitively. The higher rates are, the more sensitive buyers will be to price. And consider a mortgage rate buy down to attract more buyers. One last comment. No one knows. We are all doing our best in an environment that is full of unknowns. What we do know is that there is tremendous pent-up demand in today's housing market. Buyers have been sidelined for the last 2 years by higher mortgage rates and the hope that they would come down. Sellers have been locked in by a low-rate mortgage, but also have hefty equity gains. At some point, expectations adjust and the need to move translates into action. Please take a look at market intel on the FMLS website to access the most current market statistics. They are local and they are updated weekly. So if you are interested in resources relevant to our market dynamics and want to dive into local markets, we've got you covered. For FMLS Market Intel, this has been Leslie Appleton-Young. See you next time.